The risk of loss trading any financial instrument, such as Forex or binary options, can be substantial. You must be aware and willing to accept those risks in order to invest. Don't trade with money you cannot afford to lose. This is neither a solicitation nor an offer to buy or sell any financial interest. No representation is being made that any account is likely to achieve profits or losses similar to ones discussed here. Past performance is not indicative of future results. Any strategies discussed are for educational purposes only and are not to be construed as specific trading advice. This material is for educational purposes only. All right, hey guys, welcome to the little workshop here. Number one, I don't have any slides today. Whenever I was creating this webinar, a lot of stuff happened. Anyhow, I lost it all, so just bear with me. If you have any questions today, you can reach AJ right here. If you have any questions about Cantor Exchange, you can reach me, Ryan here, about anything to do with TraderBot Marketplace right here. I will put that up throughout the webinar as well. Okay, today we're going to be talking about trading without direction. Now, if you don't know what directional trading is, a lot of people think, and I was this way as well, a lot of people think that the market, let's say the market is moving up, it moves down, moves up, moves down. Now with currencies it's different, but with the stock market such as Dow Jones or whatever, they've got an upward bias. Now a lot of people think the market will just move up, move down a little bit, and that's the way it is. And they also think, and I remember hearing or thinking this when I was first trading, how in the world can I make money when the market goes down? That doesn't make any sense. Well, we all know that you can short stocks or you can short the market. You can sell a put, you can or buy a put. You can sell a binary. There's all kinds of ways to trade when the market goes down as well as up. And the market doesn't always have to be directional. Anybody can make money as long as the market's going up. Anybody can make money in the stock market right now. The market's going up. All you have to do is buy and then, hold on to it and you'll make money until the market doesn't go up anymore. And then you bought it to highs and now you have to watch it fall all the way back down, 1,000 or 2,000 pips. Nobody wants that. And the statistic is that about 80% of the time the market is not trending. The market trends about 20% of the time, and then the market doesn't trend about 80% of the time on average. And when the market's not trending, it's sitting there doing something like this. This is what some people call a consolidation. Some people just call it, bouncing off support and resistance, whatever you want to call it. I don't care, but you can see when the market is just not moving. It's going up, going down, maybe at the end of a trend. It will always do this at the end of a trend and the beginning of a trend, and only when it breaks out of this range. We don't know that the market is trending until it breaks out of a range such as this. And you can make money or lose money when the market is trading in a range. And I'm going to show you what I've been looking at today so that you can understand this concept a little bit better. Okay, if you'll look at this chart right here, if you scroll out, you can see the overall, it is in an uptrend, and it pulled back. Is it going to go up? Is it going to go down? Nobody knows. We don't know. So right now, the market is somewhat in a range. You can see it right here. It's not going up. It's not going down. If you look down in this area, you can see that it has not moved down to follow through on a break of support here to go down, nor has it followed through on a break of resistance up here to go up. It's not doing anything. When the market doesn't do anything, we can use that to our advantage, as I said earlier. One of the ways that I do this is by a little tool here. Let me scoot the screen over. Now we're looking at an hourly chart right here. We're going to turn this into an hourly chart as well. Let me zoom in a little bit. Okay, on an hourly chart right here, do you know how often or how far each candle moves on average? Well, you can see it right here if you look up in this upper right-hand corner. Again, I'm going to take a screenshot and I'm going to explain what we're looking at. I want you to look over here, but I'm going to explain here. So I'm going to draw some pictures here. Okay, right now we're looking at 1 hour bars. Now on every single hour, you see a bunch of dots up here. We call this the high fives. I don't know, that's just a name we gave it, it doesn't matter. We call it the high fives, and what it does, it measures the movement on every single hour, or whatever time frame you put it on, every 5-minute bar, every daily bar, whatever, it measures the movement. Now I know right now, by looking at this, that on average, how far is price going to move and expire on every single hour? Well, if I look right here, if I look right here, I can see this 72%. Now it says OTM, that's because I've got it reversed. I was working in there. Just go with me for a second. It says 72%. This is technically 72% for an OTM, which means that 72% of the time, price will expire outside of this range. Now, what is the range? Well, 72% of the time, price will expire either above this area or below this area, 72% of the time. Can we make money with that? No, we cannot. It's too close. We can't do anything with that. So let's go out to another level. Let's go out to what's called a level 2, OTM level 2. Now I know that only 33% of the time, price is going to expire either above here or below there. We know this, and we're looking at data going back, you know, thousands and thousands of bars, and on average, this is what it is. 33% of the time, price will expire outside of these two areas. Now, if we know that price expires outside of these two areas only 33% of the time, then we also know that 66% of the time, price will expire inside of these two areas, and that's for an hourly trade. So if we know the price expires inside of this area 66% of the time, and then your market price here moves up toward this area or moves down toward this area, then we know that there is a potential trade there. Let's look at Cantor Exchange. Let's go back to their platform. Now, today, what I tried to do, I tried to quote unquote push a trade through just to show you what I'm talking about. It came back to bite me in the rear end because I didn't do enough analysis and lost the trade. That's fine. I'm going to show you what I'm talking about here. Let's draw a line. Let's draw a horizontal line at 75.85. 75.85. Where are we at? Or, I mean, where are we? We're on the wrong chart. We need to go to Australia dollar. Okay, let's draw a horizontal line here at 75.85. 88. Let me find it here. Where is it? There we go, right there. We're going to draw a line right there, 75.85. And then we're going to draw a line also at 75.95. I need to pull this down. There's our line at 75.95. Now, we've got a line in here, 75.95 and 75.85. I want price to expire inside of this area right here. If it expires inside of this area, then I know that I bought at 75.85 and I sold at 75.95. Now the prices are kind of whatever, but just go with me for a second here. I bought this one at 75.85 for 95. Was it a good price? Probably not. Same thing with this one. It probably was not a good price, but I got in. If price expires in the middle here and does not even move, I'm going to win both of these trades. And there's no way that I can lose both of them. I can win one and lose the other, but I cannot lose both of them. It's impossible. The only way that I'm going to lose one is if price expires above this line or below this line. One of those two has to occur for me to lose both of these. If price stays anywhere in the middle here, I'm going to win both of them. But you see, I can't lose both of them because if price expires down here, I'm going to win the one that I sold and I'm going to lose the one that I bought. If price expires above here, I'm going to win the one that I bought and lose the one that I sold. So I can't lose them both. I can lose one. Now the typical or the ideal thing to look at whenever you're buying these contracts, buying down here and selling up here, you're looking for a good price. And sometimes it takes quite a while to get that good price, and the better prices come in the mornings, actually. But the typical thing to do is to never buy more than the probability suggests. So if I'm looking over here and I can see that price stays inside of here 66% of the time, then between both trades, I don't want to spend more than 66, which I did. I'm trying to show you. But I don't want to spend more than 66. So what is 66 divided by 2 trades? That's 33. Now, are you going to be able to get each trade for 33? Probably not. You're probably just not going to be able to get that. But you can get one for, say, 40 and then the other one for 10 or something like that. We're looking for those ideal trades. They are out there. They're not out there today. So if this trade expires inside of here, I'm going to make 5 cents on the upper contract, or on the lower contract. I'm going to make 11 cents on the upper contract. That is 16 cents I can make on this contract. If I can make 16 cents on the contract, how much am I risking? Well, I'm risking 84. That is higher than this 66% that I talked about earlier. Are you guys following me so far? Do you understand what I'm talking about? If you can, type yes. If you don't, type no. All right, thank you. So whenever you're in here looking at the market, there's certain things that you can do. You can scan the market. I scan the market all the time. I'm in here looking for contracts. These are called butterflies, or you can call them whatever you want to. If we're trading in the opposite direction, we can also trade what's called a straddle. Now, don't get me started on the splitting hairs between what a straddle and what a strangle is. In binary options, they're all straddles. That's fine. It's the reverse of what we were just talking about. A straddle is you want to spend a little bit of money to buy this contract up here, and you want to spend a little bit of money to buy this contract down here. So it's kind of in reverse. You're not risking a whole lot. However, price has to move in order for you to make money. It's got to move and expire above here, or it's got to move and expire below here. Again, you're not going to lose both contracts at the same time, but you can. You can on a straddle. You cannot on a butterfly, but you can on a straddle. If price moves up and expires above here, you're going to win this strike up here, which you didn't pay a whole lot for. Or if price moves down here and expires below here, you're going to win this trade and lose this one. However, if price expires anywhere in the middle, right here, you're going to lose both of them. So you can look at it like this. If you're trying to trade where you want price to remain in the middle here, it's going to cost you more. However, your payoff is going to happen more often than it doesn't. If you're trying to trade where you want price to move, but it's not going to cost you a whole lot, your trade is going to lose more often than not. But when it does, it's going to pay off larger. And that's called a straddle. So those are two. That's what we call directional versus non-directional trading. When you're trading directionally, you're saying, okay, I think the market is going to go up, or I think the market is going to go down. When you're trading non-directionally, you're saying, I don't think the market's going to move at all. It's going to sit there. And a lot of the times it does. Actually, about 80% of the time the market sits there. So we're going to go to an hourly chart just to take a look at it. Now here's an hourly chart right here. Let me check my prices. Give me a second. Hang on. 75.85, 75.85, 75.95, 75.95. Okay, now in order for me to lose my trade, this bar right here has to climb all the way up here and close above here. If it doesn't, I will win that trade. And like the same thing for this strike down here. It's going to fall all the way down here and close below here. What do I think is going to happen? Who knows? We don't know. I don't know. in my mind, where I try to rationalize everything, I am telling myself, okay, price has been consolidating for a lot of hours here. It's got to really move like what it did on these two bars here for it to close above here or close below here. Does it usually move like that at 3 o'clock in the afternoon? Usually not. Usually not. But it can happen. It can happen. So, but right now, my money, which is not a whole lot, it's like, you know, $1. My money is on price remaining in here at least for the next. How long's left in this contract? For the next 43 minutes. That's what I want price to stay in here. Okay, so let's talk about risk. What is it more risky to trade this way? Well, let's look at some numbers. If you look over here in this area, we can only do a straddle right now. We can only buy up here and sell down here. That's the only thing that they offer. You see this line, we can sell right here for 85, or we can buy this line for 16. So, you know, what would be the risk there? It'd be 15 there, 16 there, so it'd be 31 for the entire contract if you're doing a straddle. You can't put on a butterfly right now. Just can't do it. There's not any liquidity there. But whenever I'm looking for these, whenever I'm looking for butterflies or straddles, again, I'm looking for a good price. My goal is to sell the upper for 20 risk, or I mean reward, and buy the lower for 20 reward. Now, when I do this, I'm still risking 60 to try to make 40. What's the most that I can lose, though? What is the most I can lose? Well, the most I can lose would be this. We got two contracts. They're both worth 100. So if I risk 20 on one, I mean, if my reward is 20 on one, then what is my risk? Does anybody know? What's my risk? I'm gonna get me a cup of coffee here, or a sip of coffee. My risk is 80. Why? Because every binary contract is equal to 100. Okay, so my risk is 80 on there. Now, on my lower contract, if my risk is also 20, I mean, my reward is also 20, and my risk is 80, what is my risk and reward on both trades? Well, let's just keep going. So right now we've got 160 risked, but is both of these risked at the same time? No, they're not, because you can't lose both of them. Your max risk is going to be 80 minus 20. So that would be 60 is your total risk. You see, I told you guys, I totally messed up this webinar. I do appreciate it. I'm trying to explain it here. So if your risk is 60 and the market consolidates 80% of the time, then is that a good trade? Of course it is, if you can get that price. If you're risking 60 and the market is staying in a range 80% of the time, that's a good trade. But what if you're risking, let's say, 90, like I did here a few minutes ago? Is that a good trade? No, not necessarily, because you're risking more than the probabilities suggest. So if you're risking more than probabilities suggest, you may win that trade today, but you're going to lose it more often than not, because as the law of statistics states, you know, well, I don't know what the law of statistics states on that, but if you risk more than the probability suggests all of the time, you're going to end up having a negative equity curve, so don't do that. So we're going to go in here and we're going to look and see what we can find. We're going to look at 1600 expiry. Okay, there is no butterfly trade there. There's not one there. There are straddles all over the place, and you can see them right here. 82, sell at 82, buy at 18. Here's one. Here's one. Okay, so we can buy right now. This is Euro Yen, and we can buy the 132.90 strike down. Where's it at? 132.90. We can buy this strike right here for nothing now, but we could buy it for 90, but it just went away. And we can sell this strike for 6. Not a good price. I'm not gonna do that. But let's look at Euro USD. We got a straddle, but we don't have a butterfly. USD yen. Okay, late in the day, they're going to be hard to come by. And let me check this one more time. Okay, there's no more available today. It's we've got 38 minutes left. So, but anyhow, that is trading non-directionally. How many times have you been trading? And let's say, I don't know, you took a trade right here. How many times have you taken a trade, you know, like really close, like right here? Here's the strike. Let's say here's the strike, and you took a trade and you know, it sat there and it didn't do anything, and you lost your trade by, I don't know, a tick. I've done it. However, by placing it, by buying up here and selling a little bit higher, you minimize some of that risk. Okay, does everybody follow? I'm getting absolutely no feedback today. If anybody even remotely knows what I'm talking about. If you do, please type yes in the little chat box. And if you don't understand, go ahead and type no, and I will try to explain it a little bit better. Also, if you have any questions, let me know that as well. Now, let me go back over here. I am looking at how often price expires in between certain levels. Let me ask you this. What if price here moved, I mean, really, really moved, and it went up? What if this price here went up to, say, this level 3? It just shot way up there. Well, what are the probabilities that it's going to close below there? Let's go over here and look. We got ITM 1, which is this level. We got ITM, and that's 27%. It'll close below there. 66%, it'll close below there. 84%, it's going to close below there. So what if, and you know it's got an 84% probability of closing below there. But what if price falls? Same thing, 27%, 66, and 84. So we know that price has an 84% probability of closing in between this area right here. Now that's a pretty big area. Are you going to be able to take a trade on every single bar? No, you're not. However, when the market does move, let's go back to the last one. Right here, it closed underneath that 84% probability. The market moved up during that hour, and it closed right under there. And it does that most of the time. And you can see right here, most of the bars are not going to be big at all. And the bigger bars are going to be in the early mornings. That's just when the big bars come. In the afternoons, they're not going to be nearly as big. And a lot of times the market's going to sit here and do this for a long time. You may not be able to get a price way up here, but if price moves, that's when you can hop on board. You don't want to do this during news at all. If there's a big news announcement coming out, non-farm payroll, the Fed announcement, something like that, or maybe a politician's getting ready to speak, you don't want to trade anything during these times because the market could just, I mean, flat out go without, you know, it can go and not even stop. Really, the last time something really shocked me was on election night in 2016. Where's my thing? And I want to show you what happened during that day. Where are we at here? Let me see if I can run back there. Okay, here we go. Election night 2016. And I just lost it. I want to rewind again. Right there. Who can spot when the election happened by looking at this chart? Can you spot it? Right here. These two bars, this is beginning when it started, and then right here is about what is this? About 8 hours worth. 8 hours worth of volume. Price initially shot up and shot back down. So this is what a news announcement can do. So don't trade through news announcements at all. I don't. There's no way. I'm not going to speculate, but I'm pretty sure this bar right here is a news announcement. So you can do this on, 5-minute time frames as well. How far will price move during a 5-minute time frame? And you have to know how far. Now, if you don't have this tool, how can you know? Well, you can count it. You can do the math. It's basic math. Basically, you can count the bars, you can count the levels, and you can add up how often something happens. Keep that in a notebook. I kept it in a notebook for a long time before I had this programmed. You can keep it in a notebook, and then anytime something else happens, you write it down, and you never get rid of that notebook. And whenever you have a notebook and you're writing down all your ideas and thoughts, you can go back to that later and they will make sense. Hang on a second. So on a 5-minute time frame, let's go to a 5-minute time frame. I've already got the strike set at 5 pips wide, which is exactly what it shows on Cantor Exchange. How often does, when the bar opens, how often is it going to close either at the next strike level 5 pips up or at the next strike level 5 pips down? It's going to remain inside 65% of the time. It's not going to close beyond any strike 65% of the time. So if we're looking here, like this is a 5-minute bar. What's the next strike down right now? Well, we've only got 2 minutes left in the contract, but let's see here. 70, 75, 95, we can buy for 20, which is above the price. Let me pull that down a little bit. Right here. Now, do you think this one 5-minute bar is going to go all the way up here and close above here? No, but can you get a price for it? No, you're not going to be able to do that. So what's the next price down? 75.90, which is right here. Can you get a price for that? A lot of the times you can. You can't right now. There's no price available. But a lot of the times you can. And we know that 65% of the time it's not going to close beyond any strike. So what happens if price moves up here and gets really close and there's a really good price here that, let's say, it's less than the probabilities over here? Well, that's a good trade. We can do that because we can see, over the past, I don't know, thousands of bars, 65% of the time it closes above there, or it closes below, inside of there. We can also see where the market has never been. The market's never been on one 5-minute bar. It's never moved 20 pips as far as, however far I'm looking back, which I think is 20,000 candles. So we know that if price really moves on that one bar, it only has a probability of going less than 20 pips. So based upon all of this, if you continue to get in there and figure out how often, and it goes along everything that I've been talking about over the several months that we've been doing this. If you just start writing down notes on things that happen in the markets, it's going to help you a whole lot better. Start looking at candles. How far do they move on average? At what time do they move? Because time makes another hang on. Time plays in as well. If I'm only looking at if I'm looking at 24 hours, it may show me 65%. But if I'm only looking between 8 a.m. and 3 p.m., it's going to change. Now I know that between those times, only 58% of the time does price expire in there. And I also know, let's pick one time, one hour of the day. The hour of the day between 8 and 9 a.m. in the morning, we know that price is probably going to move beyond one of those strikes. So depending on what time you're trading, you can see the probabilities of how far the market's going to move. Okay, guys, I know I have dropped the ball on this webinar, so I do apologize, but Again, if you understand, let me know. If not, let me know, because that's about all I've got today. If you learned anything, let me know that. If you did not, let me know that. And as far as I'm concerned, the webinar is done. I do appreciate you attending. If you have any questions, put them in the chat box, and I will answer each one as they come along.